If we rewind the clock a year and talk about what we thought we'd see going into 2024, the first thing that worried me was that there might be a domestic political crisis that could test the markets because of the divisions in the U.S. I'll have to say that didn't happen. A little surprised, but happily so. We worried about geopolitical shocks testing the markets, and despite all of the headlines, that didn't happen. We're worried about volatility among individual stocks. We definitely saw that happen. And lastly, the private market revolution with some new ways to invest. But let me just take a moment to talk about those individual stocks. Most of our clients are pretty diversified. Certainly, if we've had the chance to work on your portfolio for a bit, if there weren't some major tax implications to it, we've had you pretty diversified and you might not have noticed. But if you're one of those investors that might have had a little bit extra in a particular stock, either it was a great year or it might have been a terrible year, we all had to get used to the idea that individual stocks might be moving up or down more than 15% on any given day. And so really an unusual confluence of events where there was so much volatility among individual names, yet such a calm market overall if you were diversified. And then that last part, the private market revolution, we talked about that throughout the year, but just for those that aren't aware, when I say there's a new way to invest, what I'm talking about is that there are now new vehicles, you'll hear the word BDC repeatedly, whereby you can put money into the private markets when you want and get money out of the private markets when you want. In the past, when money went into the private markets, you really had no idea when money might come out. It could be a year, it could be 10 years or more, certainly if you're thinking about equity, but sometimes even too with fixed income. But with this newer type of vehicles, we expect to have much more flexibility than we ever had before with private markets, making them almost as flexible as public market investments. So when I put my financial planning hat on and I think of any client's allocation like a pie chart, this much in public equities, this much in public fixed income, this much in cash, so on and so on. Now we can resize the pieces of the pie much more frequently, much more is appropriate for changing client situations than we ever could before, with both the public and the private being allocations that are readily changed. So that's just a game changer for your financial plan and a game changer for your investment strategy. As we get into the next part here, the market recap, again, you'll see the headline is American Resilience. And let's start that by looking at what other experts had to say about 2024 at the beginning of the year. I think my comment was that I've rarely been more excited about being a stock market investor. But when we look at these experts' 2024 estimates versus the actual, what you'll see is that not every expert fared so well. So again, we were enthusiastic with a few cautionary warnings out there, but the S&P 500 index on a price basis was up 23.3%. And when you look at all of these very well-known firms that are well regarded for their expertise in the markets, none of them even came close with their forecasts. In fact, none of them even predicted a market return that was half of what we actually got. Quite a bit of pessimism out there. And if you recall back at the beginning of the year, we were still having the debate as to whether or not we were going to go into a recession. So I'd spent 4 years saying we're not going to have a recession. And a lot of folks were still clinging to that thought, to the point where some folks were saying we were going to be down double digits. Well, obviously, it was a terrific year in the market, not just for the S&P 500, but for the global equity index. As we look at how that unfolded throughout the year, what you'll see is that it's very calm. And if we're not talking about purely economics, but politics, we've got some of the big events there in politics that I think might have explained a lot of what we're likely to see going forward. And then we'll throw in all of the economic things that we normally talk about. And it's not uncommon to look at a year or even a quarter where the headlines quite obviously drove the markets. In this case, there were many dramatic headlines, some of them positive, some of them negative, but the market just stayed flat. And so whether we're focused on the politics, and again, I think the three big events there were probably when the The border deal was declared dead, the bipartisan deal, of course, Biden dropping out of the race, and then eventually Trump winning. None of that really moved the markets all that much. But even the economic stuff, when the politicians have to negotiate to the final hour just for the U.S. to have a functioning budget, I consider that a negative. The markets took it in stride. Even when the Fed lowered interest rates 50 basis points and surprised everybody, the markets took it in stride. So there's two different stories to be told about 2024. There's the stress we all felt as we're reading the headlines, and then there's what's actually happened in the markets and with their investments. And in that second case, what we're really going to focus on today, it was just this steady march upwards. If you look at your quarterly portfolio report, and those reports have gone out, what you'll see is that the indexes had a pretty modest quarter, but a really terrific year. So I really want to focus on the year being up 16.37%. And I'd be remiss if I didn't redo that calculation to also squeeze in the 4-year return, something that we like to do when there's been a presidential election. And so for the 4 years, you'll notice fixed income did not do particularly well. We were coming off of near zero interest rates, and then suddenly they rose. I put that blame on the Federal Reserve for overstimulating the economy for too long. But from an equity standpoint, right at about 8% per year on average, so a very solid return. If we go to the next slide, what you'll see is that in all fairness, we've got this calculation from 4 years ago as well. So you can see the 4-year average return ended in December of 2024. And then there's the 4-year return ended in 2020. Now, what happens in the White House is by no means the end of the story. The economy that a new president was left with is part of the story. I'm not trying to make any assertions with this slide. I just want to give our clients all the data to look at. And perhaps there is a lesson to draw from this, which is that when you are a stock market investor, I think you are choosing to participate in an economy, in a country, in an institution that is bigger than just who is in the White House at that time. And if we didn't know it already from looking at history, we can be reminded here that the stock market can be a successful place for us to invest in regardless of who's in the White House. Now, taking an even longer view, going back 20 years here with this chart, there is one big point that I'd like to make. It's not just that if you invest in the long run and do it reasonably well, all asset classes should go up. There's also the point, if you look within stocks, that the performance of the U.S. stock market has just been unparalleled. There was rarely a quarter where the U.S. stock market was the best stock market to invest in around the globe. But over a longer period of time, the U.S. has very definitely been the best place to invest, to the point that the U.S. stock market is now about 2/3 of the value of the global stock market. And so our headline there is American resilience. And so whatever your politics are, whatever you think is wrong with this country, whatever you'd like to see changed, somehow over the last 20 years, we just seem to have done it better than just about any other major economy in the world. And it's just amazing to see, and probably good for us all to be reminded of that phenomenon with some data. There's another chart that breaks things down in a bit of a different way. We're looking back here at 7 years, and the data is not available through the end of 2024 just yet, but let me assure you that the trend continues. And that's showing first the United States and the size of our economy versus other countries. I remember back in 2017, we had all been prepared for China to overtake the US. In fact, I'm pretty sure in 2017, there were some predictions that in maybe 5 years or a little bit more, we would see China's economy be bigger than the US economy. Of course, we had no idea that the pandemic was coming our way and many other events as well. But if you look at that gap in GDP, it's about $7 trillion back in 2017. Now that gap is about $10 trillion. So proportionately, we're ahead of China about as much as we were back in 2017. So we're not just keeping up, but we're growing. There's also the data here that shows you how other countries rank. And even though these major developed economies are in the news a lot, it is worthwhile to note that if California were ranked as a country, it would be the fifth biggest economy in the world. I don't think it's intuitive for us to all know that California has a bigger economy than does India, than does the United Kingdom, than does France and Italy and Brazil. Texas is bigger than Italy and Brazil and Canada and Russia. New York is right there ahead of Canada and Russia. I mean, if you just ask the average investor, do you think the economy of New York is bigger than the economy of Canada? They'd say, no way. So, when we look at even these larger states and see how big they are on the global stage, we are reminded at just how well the United States has done. There's a call out here on this slide as we're looking back at the last quarter and some longer periods that the U.S. stock market is now 65% of the value of the global stock market. If you buy the Vanguard Global Equity Index, you'll see that you're 65% in the U.S. Even when you bought a global equity index, there might be 12,000 plus stocks covered in that global equity investment, but the 3,500 that are in the U.S. amounts for 2/3 of that when you add up the dollars. Another thing to look at for the last quarter is that once again in the United States, large growth stocks did the best. That continued outperformance to this degree is going to cause me to issue a little bit of a warning as we go farther into the presentation. Looking at developed markets, you've got some other data there. Again, not a great quarter. Some of that has to do with what was going on with the value of the dollar relative to other currencies. We overweight the U.S. and we've had to continue to move our allocation to the U.S. up to stay just a little bit ahead of the growing U.S. dominance of the equity markets. And now the international developed markets are down to 24%. Not that long ago, that was north of 30% of the total. Emerging markets continue to be a smaller and smaller part proportionately. They have grown over the last year. They have grown over the last 5, 10, and 15 years, but just not nearly at the pace of the United States. And then we're going to settle here for just a minute. Let me focus you on the Treasury curve at the top. We're at the black line now, which looks very normal. And when I say normal, I mean that in the most technical sense of the word. Short-term rates are almost lower than all long-term rates. Rates gradually go up as we go to longer terms. We've got 1 or 2 more rate cuts in front of us that we think we're going to have before this year is out. And then short-term rates, overnight rates will be the lowest. Long-term rates will be the highest. And it'll be one of the very few times in my entire career when the yield curve looked like they teach you in economics that it's supposed to look. And perhaps this is the end of the Federal Reserve dominating the economy and dominating the yield markets, and we can let markets be markets for a while. If you look back at the prior quarter or the prior year, you'll see a very twisted yield curve where short-term rates were quite obviously too high. As you get past 3 months and 6 months, it's the markets that control. They look kind of normal past that. But again, if the Federal Reserve catches up to the economy with 1 or 2 more rate cuts, then all that's going to look quite rational. At the bottom of this page, what you'll see called out here is that for the last 3 years, investing in fixed income has been a pretty dangerous thing to do. If you owned the wrong thing, you could lose a lot of money. If you just own the index, you lost almost 2.5% per year before any fees or taxes. For the last 3 years at BIP Wealth, our fixed income investment strategy for our clients has been almost exclusively in 3-month treasury bill vehicles or floating rate treasuries that are geared towards that. In other words, we realized more than 3 years ago that it could be a treacherous time for fixed income, and we dramatically shifted how we invest. In fact, we've built a whole investment strategy. Many of you may see this in your reports, called the short-term tactical strategy, where we have an account or accounts that are solely devoted towards investing in short-term treasuries and floating treasury vehicles, meaning we're not so worried about FDIC limits because there's no limit to the full faith and credit of the U.S. government behind treasuries. And we're not worried about interest rates moving up and down because the rate floats to keep up with the market. So the return over the last year for the 3-month Treasury bill index was about 5.25%. And if you had your money invested in short-term tactical, that's probably pretty close to what you got. That sounds pretty good, but if you look at the 3-year number, that's the best place to have invested. So again, you might be hearing about that from your advisor already. If you have money that's going to be spent on something in the near future, a new house, a new car, it's going to go into the private markets, you're planning to just distribute it if you're living off of your portfolio, you may very well have a short-term tactical portfolio that's been set up to invest in what you see in the green bar there. Now let's talk about the future a little bit. I do think there was a quarter or two where I barely mentioned artificial intelligence when we were going through 2024, but it's time for that to end, and we're going to do a little bit of a deep dive on that today. So let's talk a little bit about AI. There are some tests that are routinely done against various artificial intelligence services out there. And what we have here is a chart showing you how well ChatGPT 3.5 and then 4.0, which came out in March of 2023, did when taking some, in some cases, rather difficult professional or academic tests. Now, the GRE is going to be the easiest of those. What you see is that when ChatGPT 4.0 was released, it scored in the 99th percentile of test takers of the GRE. So obviously pretty smart in comparison to that group. But in fact, if you look at the SATs, you look at the LSATs, you look at the bar exam, you look at all sorts of other tests, ChatGPT did exceedingly well. Where it still struggled just a bit was in the calculus advanced placement exam that is given to some of the mathematically brightest high school students out there. It only scored in the 43rd percentile. What I would suggest is for those of us looking at this chart today, we each might think we could do better than ChatGPT in maybe one or maybe two of these categories. But I'm not sure that there's a lot of us that think that we could do as well as ChatGPT 4.0 across this range. And I think that this is just a great way to understand how competent ChatGPT 4.0 is, as well as its competitors. And that's not even the latest version of ChatGPT now. So their 4.0 issue is more advanced than their 4.0, and so it's scoring even better. We can just expect this to continue to move upwards. One thing we've seen happen over the last 2 years, since I first began talking about artificial intelligence, is that it is becoming extremely common to work with AI in the workplace. This is a chart of different jobs and how likely it is that you're being exposed to AI in your role. This isn't depicting how many jobs have been lost to AI or anything like that, but we might think back to a time when any kind of accounting or bookkeeping was done purely on paper ledgers. I remember that my grandfather, who was in the insurance business, had a mechanical adding machine, and it was just full of keys, more than 100, and you could punch in different numbers to do math. There was a big crank on the side of the machine that you would pull, and that helped people that were using a paper ledger to be much more accurate. Eventually, that got replaced by spreadsheets. And now that is often being replaced by AI. not just to do simple math and spreadsheets, but to create the spreadsheets and to do all sorts of other things. So if you're in a job there that's at the bottom of that table, grounds cleaning and maintenance, you might not be seeing a lot of AI yet, although that's coming, I suspect. But if you're working in office and administrative support, 46% of people in that role are working with AI. And again, the parallel might be, how might they be working with spreadsheets? Well, that's going to be almost everybody. How many are working with AI? That's almost half. And if we look at this a year from now, I am going to guess that those numbers are substantially higher. And so if you're in the workplace now and you're not about to retire, I think the way to view this is to say, how can I work with AI? How can I be that employee that is using AI to bring an advantage to the firm, the department, the group that I work with? Because you're not going to be able to dodge it. For those of you that follow the AI news, you might be aware of a project called Stargate, and then more recently one called DeepSeek. So just to talk about Stargate, there is an effort being put together, announced by the new administration, to bring in money from SoftBank, the big venture capital firm, from Oracle, and also from OpenAI, which are the owners of ChatGPT. It's purported to be a $500 billion investment pool to advance artificial intelligence in the United States. Well, that got a lot of attention, generated a lot of enthusiasm, all this money going towards AI, but frankly, in a manner that we've grown accustomed to. When we hear about resources being dedicated to AI by all the top technology firms, Google, certainly Meta, Microsoft, all the others out there, we hear about this in $10 billion and up increments. But then just a few days ago, a Chinese hedge fund called DeepSeek rolled out its new AI. Now, there's a little story to tell here. This firm, DeepSeek, was a quantitative investment firm using sophisticated math and very rapid processing to try to gain an advantage in the market. And they had bought a few thousand NVIDIA chips, an older model, a detuned model, if you will, that didn't violate any of the export restrictions that exist around these types of chips. They tried to build an AI model to do their investing calculations for them, and it didn't work. It wasn't better than what they were already doing. It turned out to be worse. And so with this resource already in their possession, they decided to tweak how it worked and rolled out an AI model. They used a lot of publicly available information and perhaps ChatGPT and other AI to train this new model very quickly. And so with a chip investment of only $5.5 million, they rolled out DeepSeek. It is already the most quickly downloaded app on people's iPhones. And for a minimal cost, it is apparently very competitive with ChatGPT 4.0, and in some categories, perhaps even better. This has shaken the artificial intelligence industry to its core. Again, it looks like they let it learn off of some other AI models, but for a very modest investment and perhaps some good coding and a little bit of sneakiness about how they got this done, they trained up a model. Training an AI model is a bit like raising a child. There's lots of teaching that goes on. And so they were able to do this very quickly with a minimal investment that calls into question the budgets of these big US tech firms, calls into question the need for the most advanced chips. I'm not going to get into all the details about how more rudimentary it was. Obviously, the mouse on the wheel is, or hamster on the wheel is a little bit of exaggeration there, but it was a much simpler effort than what we have grown accustomed to hearing about and is apparently competitive. And so now you as a user can choose, do you want to pay for ChatGPT? Do you want to pay for DeepSeek? And when you query it and you pay for these outputs, now they're called tokens. The number of tokens represents how complex the output is. You can get output from DeepSeek for free or nearly free that might be very expensive to get from ChatGPT. And so this is a game changer, and we're going to see how this develops. But if we were having this get together a month ago, we wouldn't have known anything about this, and we would have assumed that all future AI development was going to require this type of $500 billion investment. Maybe not. Talking a bit more about the future of AI, I just want to arm our folks here that are watching today. We are using a lot of what's called narrow AI right now. The GPS on your phone is narrow AI. Many purpose-built AIs for specific tasks and businesses are narrow AI. But at some point, we expect to have general intelligence. And this point is referred to as the singularity, and that has to do with the way information isn't viewable past the singularity or the center of a black hole. If you know just a bit about astrophysics there, what's going to happen with AI is there is going to be a point where we don't know what's happening. Now, there are limited instances of this already. Some of the AI models are learning on their own in ways we don't understand. They're learning foreign languages that they've not been taught. There are AI models that can read medical scans and detect cancers and other problems, and nobody knows how they're doing it. They're getting so good, so smart, that they're moving past the human ability to know what's going on. And so once this happens at broad scale, that's referred to the singularity. We talk about it as the AI escaping the lab and then being able to self-improve and learn at an even accelerated rate that we just are unable to understand and perhaps unable to manage. And so there are future steps to this that can get a little bit scary, all the way up to levels of intelligence that far supersede anything that any one human or group of humans is able to muster. If you're a science fiction fan or perhaps just a movie fan, you might be a bit familiar with how that type of scenario has been depicted in the form of agents. Agents are coming. And so in the Matrix movie, they showed us what happens when agents go rogue. Or maybe you're a fan of the Terminator and you had, in that case, the robots still working for AI. Well, you may have robots in the next year cleaning your house. You may have robot cars already that are ready to drive for you, or maybe you're just working with the agent that is already there on your phone. But let me make a point about what I mean when I say agents. Some of us have a little bit of this already, but perhaps when we're speaking a year from now, most of us will have AI agents working for us. What I think is going to happen is this: the AI agent that we have, each of us will wake us up in the morning, talk to us about the agenda that we face, perhaps suggest what would be the healthiest breakfast to prepare, talk about whether we're going into the office today or we have social appointments or recreation that is on our calendar. If we're working out, maybe the type of workout we should be doing today based on how well we slept, what our heart rate was, what our breathing was, helping us to manage ourselves, helping us to manage our schedule, helping us to manage how we interact with others. Oh, you've got some friends or family with a birthday coming up. Have you bought a gift yet? Your significant other said something to you a couple of weeks ago about how we haven't gone out for Mexican recently. Should we have Mexican tonight? Should I book a reservation at our favorite restaurant? Should I order out and have some Mexican delivered? All these things are going to become routine. And that AI agent, if we're working, is going to follow us to work. It's going to help us to decide what our priorities ought to be at work. And it'll blend the home life, the work life, and everything about how we manage ourselves as a trusted, highly competent, highly intelligent, almost all-knowing advisor to our lives, to the point that we can task our AI agent with doing all sorts of things for us that we would normally have to do ourselves. If we think about the car already wants to drive for us, and we know that that push is coming in an even bigger way. The robot that we have will also embody the same AI agent, and it's going to vacuum the floors and do the laundry and fix the meals and change the baby's diaper and do all of these things for us if we're willing to let it. Now, hopefully we're not eventually fighting them as they try to destroy mankind, and some of those other movie depictions of that. But I guess we'll see when we get there. As we think about this uncertain future and all the crazy things that are going on right now, I am reminded by a quote from Carl Sagan that we're going to get to, but this is the best example of how the world has gotten ahead of us for most of us. I don't know if anyone on this call is a theoretical physicist or not, but let me just ask if you understand this latest news release from Google and their head of quantum computing. And he talks about how their new Willow chip passed a standard AI computing benchmark test in under 5 minutes that would take one of the world's fastest classical supercomputers 10 septillion years, way longer than the time span of the universe. And the reason that it's able to do that, he says, is because quantum computing chips rely on the many worlds theory of quantum mechanics, and in fact are doing these calculations in the multiverse. Now, just to let you know how that went down, that sent quantum computing stocks through the roof because of this statement, because of this progress, because of the attention that it garnered. Well, a few days later, a few folks like Mark Zuckerberg and others said, I don't think that's accurate. This might still be 10 or 20 years away. And then all the quantum computing stocks fell harshly. Then some other people started weighing in saying, no, I think it's around the corner. This is very doable. And yes, we live in a multiverse. And then the stocks all rallied back. What are normal people left to conclude about this type of debate? I mean, we can go spend 10 minutes talking about how quantum mechanics works and why this phenomenon is, in fact, pretty good evidence that we might live in a multiverse. But at the end of the day, if we're not a theoretical physicist, how are we going to decide what's the best stock to own? How are we going to make these decisions of what these companies are even worth? We're just left to rely on others to suggest how this all might work. And it just reminds me of how far technology has come and how very few of us are in the position to really be able to understand all of this uncertainty about the future. One of the powers of being diversified, of investing in the market, is that you're going to get the benefit of these advancements by owning the market to some degree. Whereas if you're just going to pick individual stocks or hire someone to do so, this is going to be up to you or them to understand. Otherwise, how could you possibly decide which of these technologies is going to succeed? Let's talk for a minute about cryptocurrency, and here's just a few tidbits, and then I'm gonna try to worry everybody a little bit. Right now, there are over 10,000 cryptocurrencies. I've met very few individuals that can adequately explain how blockchain technologies work, but let me just summarize it by saying that the use case for blockchain or for crypto is thought to be the utmost level of secrecy. Nobody will know what it is that you're doing. I personally do not believe that that is the case. I think that a lot of blockchain technologies have already been hacked. Certainly, there's the promise that quantum computing will be the end of all of that secrecy. Nevertheless, the lack of a viable use case hasn't held back crypto. And if you add up the value of all the crypto out there, it's now more than $3.5 trillion. An amazing number to see. It was only $1 trillion just a short time ago. Bitcoin represents about 57% of that value, and Ethereum represents about 11% of that. What comes behind that includes an awful lot of cryptos that are just pure fraud, in my opinion, where they're set up for no other reason than to fleece some speculators out of their money, where there is no use case for them. Someone is simply buying them in the hope that they're going to go up in value. And I think that could end badly. Here's a chart that gives you some information about Bitcoin, which is perhaps the least speculative of all of the cryptocurrencies. And I don't quite feel comfortable saying that, but perhaps it is. It's important to note that 26% of the value of Bitcoin right now is owned with borrowed funds. That's the amount of leverage that is out there on Bitcoin. So what that would generally mean is if you owned $100,000 of Bitcoin, you have a $26,000 loan that you need to repay to somebody. Now, let me tell you how that works, because we get exposed to this type of risk in investing all the time, and we're aware of how dangerous that can be. But if you have an account with $100,000 of Bitcoin, but you have a loan against that account for $26,000, what happens when the price of Bitcoin begins to go down? What happens if it gets cut in half? What happens if it gets cut by 3/4? If it gets cut that much, if it falls to 75% of its current value, then now your loan against the account is worth more than your Bitcoin. And you can bet that the exchange that you owned it on, whoever has that loan provided to you, is going to demand that they be repaid, maybe forcibly selling you out of all of your Bitcoin to repay that loan, maybe even eliminating the ability to have leverage long before you get to that, where all of a sudden now you've got a loan you have to repay, and the only thing you can do is sell assets. Well, if you think Bitcoin is leveraged, let's take a look at Ethereum. The average $100,000 account of Ethereum has a $57,000 loan against it. And these numbers have just been skyrocketing. And so with so much crypto being owned on leverage, I think we have the possibility for a contagion. I think that somebody could get what we would call a margin call and get in real trouble. And when we say that 57% of the value of Ethereum is on margin, we need to realize that that doesn't mean that Ethereum's got to get cut in half for this ability to leverage to go away, because it's going to start, I think, with investors that have significantly more leverage than that. If the exchange that you're using to own your crypto is Coinbase, you could get up to 20 times leverage, meaning that if you have a $5,000 investment, you might be able to own $100,000 of crypto. If it's at BEXBAC, they will allow for some investors 100x leverage, meaning $1,000 can buy you $100,000 of crypto. At Delta Exchange, it's 200x leverage. At DTX Exchange, it can be 1,000 times leverage. Now, I imagine if you're borrowing this much money to own your crypto, they might retain the ability to sell you out, or if you don't pay back the loan, to own your bank account, to own your house, to own your stock market investments, and so on. And so if we see a big enough fall in any of the cryptos, or with just a portion of the cryptos where they're owned on leverage, we could see a massive sell-off in all sorts of assets, including in the stock market. And I'm just going to guess here, but I'm going to bet that the folks that have leveraged exposure to some of this might also have leveraged exposure to some of the stock names that have been in the news for their run-up lately as well. So a contagion could start in a small crypto at a place that's highly leveraged, and it could spread as a sell-off affects negatively the price of all sorts of assets, and more investors start to have to meet this demand for their loans to be suddenly repaid. One other threat to investing in crypto is depicted in this report, and 2024 was a little bit worse than 2023, but not as bad as 2022 when we look at the losses that have been sustained out there from both hacks and scams. And I suppose the hack to scam ratio could be something that we track in the future. For 2023, 71% of these losses were because a system got hacked. The remainder of that was from scams, where somebody got scammed out of their password. It wasn't even a legitimate crypto transaction. But regardless, these two different categories of illegal activity cost speculators over $3 billion in crypto assets just in 2024. The sheer number of incidents ought to worry us all. Now, I'm not going to read the full of this, but let me just summarize a warning that we got from Carl Sagan about 30 years ago. We could reach a point in our society where technology is so pervasive and so beyond the reach of us to understand, and so beyond the reach of policymakers to understand, that we could all be reduced to trying to understand the world we live in and our belief set by consuming pseudoscience and superstition and 10-second sound bites. Does that sound at all like the social media world that we live in? If you like to look at your phone and watch reels on Instagram or TikTok, and that's how you get your news, which is how I think the majority of us are starting to get our news now, it's going to be pretty hard to understand what's true. It's going to be pretty hard to understand what's actually going on with crypto, what's going on with AI, what's going on with quantum computing. But that's the world that we're living in. And the stark warning was issued 30 years ago about that future. And unfortunately, I think we're starting to move into that future. So let's talk just a little bit about the market and inflation and a few more things, and then we're going to move into the key themes for 2025. This is the price earnings ratio of all the major global economies. The price earnings ratio is very easy to understand. It is the price you pay when you invest in the stock market for a dollar of earnings from the stocks that you bought. Now, we're at 26.2 at the end of 2023, which is substantially ahead of the global average of 21. Even that can be seen as a little bit expensive in the light of where the U.S. has been over longer periods of time. In fact, over the last 20 years, the average PE ratio of the U.S. stock market was barely 16. And right now it's at 26. Over the last 5 years, it was barely over 21. So by several different perspectives here, the U.S. stock market has become quite expensive. Another way to break this down is to look at different parts of the U.S. stock market. What you'll see when we look at the 11 different established sectors of the U.S. stock market is that information technology is by far the biggest part and also the most expensive part. In fact, if you have a technology-focused investment, it is typically referred to as a growth investment, meaning that you're paying a high price because you expect a lot of future growth. Sectors that show up as being more value than growth tend to be generally a lot less expensive. There's a lot more earnings there for the price that you pay for every dollar that you put in. There's a lot more earnings being earned by those companies that you now own. And so what we can see is that if you're concentrated in certain sectors, in particular information technology, you might be more vulnerable. If you have more of a growth portfolio than a value portfolio, you might be more vulnerable. And I remember before the tech bubble burst over 2 decades ago, information technology had grown to be about 40% of the US stock market. Although after the bubble burst a year later, information technology was barely in the double digits in terms of its percent, somewhere around 12, 13% of the stock market. So that can change, and it's evidence that owning the market doesn't necessarily mean you're as diversified as you want to be. If we look at the top 10, really top 9 stocks in the US, you can see their price earnings ratio, not based on this year's earnings, but what is expected to be next year's earnings, because that's really the way the stock market works. And the numbers don't look quite so high, at least for some of these stocks, when you look at next year's earnings, because in many cases, next year's earnings are expected to be higher than this year's earnings. And that's why for growth companies, we generally are willing to pay a little bit more. But some of these still look fairly expensive. We do say, by the way, that it's 9 stocks because Alphabet A and Alphabet C are really the same stock. One just has different voting rights from the other. So some of these big companies do have multiple shares of stock. So if you're buying the U.S. market, you do have a lot of money in these top stocks, and they're quite expensive. So if you own an S&P 500 index, how much is in those top 10 holdings? 37%. The S&P 500 index is 500 stocks, more or less. 37% of the dollars are in those companies that we just showed. What if you own the S&P 1500? That's the largest 1500 companies in the US by the value of their stock. That's 1,500 stocks, and yet 34% is still in those 10 holdings. Even if you go to the Russell 3000 or cast a wide a net as possible with the Wilshire 5000, well, there aren't 5,000 stocks anymore. There's only about 3,500, but you still have 30% of your investment in just those top 10 holdings. And I think we're at an all-time record for those numbers. I don't think we've ever seen it so concentrated. In fact, if you look at some other metrics for how concentrated we are, we can see over time that maybe we're the most concentrated we've ever been. And that is, how many stocks in the S&P 500 do you have to own for that to be half of the S&P 500? And so, again, same kind of data, but portrayed differently. Right now, if you buy the S&P 500, half of the value is in only 27 stocks. Well, this chart goes back to 1980, and so what you can see is even through the run-up of the tech boom, it's never been this concentrated. The price-earnings ratio was not as high as it was there at the worst of this, but the metric of how many stocks took up half of the S&P 500 is the smallest number that it's ever been. Now, let's pivot just a little bit, because I want to make sure I leave us with some data that's relevant to the most current situation out there in the news. This is a chart of the Federal Reserve's interest rate and what happened with inflation. And what you can see in 2020, 2021 is that interest rates had been moved down to zero because of the pandemic and then kept there, and inflation took off. I'm showing you this chart because I want folks to understand, when you keep interest rates too low, that's inflationary. Now, when you raise interest rates to a high level, that tends to cause inflation to fall. And that's where we've been. So inflation has kind of stabilized here lately. And there is a call, however, to lower interest rates. I think that there is a case to be made for lowering interest rates one or two more times this year. That's what we're calling for. But generally speaking, a lower federal funds rate is inflationary. Also, trade tariffs are inflationary. Also, restricting the labor supply is inflationary through new immigration policy. So we've got three current policy initiatives out there that are being widely talked about, all of which could be inflationary. However, there may be no greater deflationary force than artificial intelligence. Because as we saw already, we're going to be able to increase productivity, increase production, if you will, at an increasingly inexpensive rate. Even if AI is as expensive as we thought it was going to be up until about a week ago, it's still a dramatic productivity enhancer. And so we have three policies that are being widely talked about and debated. What is less talked about and debated is the fact that artificial intelligence is going to offer a dramatic pressure downwards on inflation. And so these two forces are going to wrestle over the coming 5 years, over the coming 10 years, and we'll have to see which one wins out. I tend to think that it's going to be the force of AI lowering inflation that is going to be the more powerful force, and that perhaps that is going to embolden us to have trade tariffs, to have a lower labor supply, to lower the federal funds rate without necessarily causing inflation to take off. But we'll see. That's not a foregone conclusion. And so let's set the stage for 2025. For reasons we've already outlined, I think we need to brace for a possible tech crypto crash, possibly starting with crypto. I think it's time to diversify. If you want diversified already, some of the things that, for instance, we do in private markets could be a fantastic diversification. For instance, if you invest in private credit and are expecting double-digit yields, that's more than we expect the stock market to earn over the long run. So you don't have to be over-concentrated in the stock market to expect higher returns. It's a great time to review your financial plan. The whole point is to look for hidden risks, either within your investment strategy or perhaps for other aspects of how your finances are arranged, such as how much insurance coverage do you have? Lastly, let me leave you with this point. Because yields are currently fairly high, safer assets can be very productive. We can invest in short-term treasuries, earn yields that are well above the rate of inflation. When we're owning treasuries, we're not so worried about FDIC limits. We're not so worried about interest rates moving up and down and creating downward volatility and risk of principal. And so it's just been one of the very few times in my career, and really the career of any working investment professional, where we could make this point at the end. So if you update your financial plan, you may find that you just don't need to be out there taking a lot of risk, and that you can secure your financial future and meet all your future goals with a relatively safe portfolio that's just invested in U.S. Treasuries. Everyone's situation is different, but I want folks to keep that in mind when they're getting their financial plan updated this next year. So the final thoughts are really just a review of what we've already said, but I don't want to be so scary in what I'm suggesting there that we don't feel like there's a sense of hope for the future. In fact, our key themes, I think, do give you some ways to ensure at least your investing future. But let me just remind you, a lot of companies are going to get in trouble over AI, and a lot of companies are probably going to be wildly successful. So if you're diversified, that may be your best hedge to make sure that you participate in the benefits of the upcoming AI rally. But like we said before, you don't have to take a lot of risk to at least beat the rate of inflation. And it's that mix between the two of those strategies that is very unique to each of the folks on the call, and why we want to encourage you to review your financial plan with your advisor.